Salesforce is down 30% in stock price over the last 9 months. And we need to investigate whether Salesforce is on sale right now because it's a bad company, or this could be a fantastic opportunity to buy a growth company in the AI cloud services sphere, which should have extremely high valuations and strong growth moving forward. And just to get a lay of the land, let's begin by looking at the stock price chart of Salesforce over the past 6 years. Salesforce's stock price is only up 56%, and when we compare that against the S&P 500, which is up 115%, that's pretty terrible. But to make matters even worse, if we compare against direct competitors such as Oracle, those companies are up hundreds of percent, with Oracle specifically quadrupling your investment over that same last 6 years. So we need to have a look at the business model from the ground up and then confirm what are the future revenue and profit projections for this company. Salesforce is one of the few companies that is still being led by their founder. Think of names such as Facebook, led by Zuckerberg, Jensen at Nvidia, and love him or hate him, you have Elon Musk, who has taken Tesla and electric cars from being basically golf caddies to being some of the most popular cars on earth. And these founder-led companies just have such strong direction and foresight. They are usually not so focused on the next quarter of earnings and performance. They are trying to worry about what's going to happen in the next decade. They just have a big investment usually in the company. Mark Benioff owns around 3% of all shares, around 22 million, but not just in terms of money and financial success. Their identities are tied into these companies, and therefore they have such a strong compulsion to make sure Salesforce is going to be successful in 2035 as much as it is in 2025. And Mark Benioff is said to be one of the best CEOs and leaders in all of the tech field. During times when Adobe was still selling their software on CDs in the early 2010s, Salesforce was pivoting a decade earlier, selling software online, and Salesforce has evolved to keep up in this new age era. Salesforce now offers data analytics for businesses, they help automate sales, they do customer support and returns, and all of the business is now supported by Salesforce's chatbot, which if you have a problem as a business, something is going wrong with your sales or marketing, you can just chat to the AI bot and it will help you solve your own problems so you don't have to ring up and wait on the phone. In order to understand one of the largest positives of Salesforce being its large customer base, we need to look at the idea of the central limit theorem. In statistics, when you're measuring the average of an entire group, if you have a larger group, you expect to have, yes, the same average, but your variance in your results drops off a cliff. Salesforce in 2025 is serving over 150,000 businesses worldwide and making revenue over $40 billion. And making profit from those 150,000 businesses is just inherently much more reliable than from 150 businesses, which some big tech companies have very few customers. And doing the math from that central limit theorem, I'll do it for you, but if you have 150,000 clients versus 150, you are going to be 31.6 times more reliable or less variance in your revenue and in your profit. There are definitely more impressive innovations right now. Just looking at Nvidia as a classic example, the technology is the best in the world. The semiconductor chips and how they arrange them in their computer systems could now power graphics and computational software thousands of times faster than they could a couple years ago. But the problem with Nvidia is some of their largest customers make up 23 and 16% of their total revenue. Probably just the big tech names, Facebook, Microsoft, and also Amazon, they probably make up 60-70% of Nvidia's total revenue. And therefore, in this one aspect alone of safety and less variance in the business model, Salesforce actually wins against Nvidia. And Salesforce achieves this by working, yes, with tiny small businesses, people starting up their websites for the first time, but also with large business as well, with 90% of Fortune 500 companies using some sort of Salesforce product. There are two general ways to increase profits for any company. company. The first is to increase your revenue and total sales, and the second is to cut down cost or at least stop them from growing as fast as your revenue. Salesforce is attacking both of those components using artificial intelligence and technology. Starting by cutting costs, Salesforce just in the past week announced they're going to replace 4,000 customer support roles. So you call up someone on the phone and a human talks to you. Well, around 40% of those people are now gone, and 50% of all customer interactions are now handled with verbal AI chatbots. And with the reduction in workforce, there's just a huge amount of cost savings. Humans do cost a lot of money to hire. So you have, yes, the direct $200 million in salaries, and probably with payroll tax, that might jump up to, $250 million. Artificial intelligence is also integral to the core business. It's not just about cutting employees, it's making every single person working there more efficient. And there's already some stats coming out in 2025 that 41% of all software code is getting written by artificial intelligence. Instead of humans doing the grunt work and typing out all the code, we've almost elevated humans now to be supervisors of little AI workers who are doing all the grunt work, the dirty work. But there is an argument that the savings to these companies hasn't even really started yet. There was a recent experiment done with coders, which is actually quite groundbreaking. What they did is they took coders and they timed how long they would perform 246 coding activities. They had one control group that did the experiment with no AI, and the second group were allowed to use AI. Both the economists and the experts expected around a 40% increase in speed using AI to code. The coders themselves were expecting around a 22% increase in total speed. However, the results of the experiment showed they were just as fast as people doing it by hand, but at worst, they were 40% slower. This experiment was only done a few months ago. So this is the technology that is currently being used by tech companies and Salesforce trying to make their businesses more efficient, but it could be actually making them slower. If you're a Wall Street suit, you probably saw this experiment as a complete disaster. These tech companies have invested trillions of dollars and it's all a complete waste. But as always, I think a little bit different, bit left of field, and I see this as a great opportunity. The companies like Salesforce, Google, Amazon, and Microsoft, these companies are not even seeing the returns from AI just yet. We're probably going to see them in the next couple years. The technology is only getting better and better each year, and the coders themselves need to get used to it. What to go through is the hardcore financial income statement of Salesforce, because we see some really nice trends that are going on in terms of cost and revenue. Having a look here, we see revenue is growing around 10% moving forward, which is not that great, but I think they could re-accelerate revenue growth moving forward pretty easily, especially implementing some of these AI services. The good news is their costs are barely growing, up only a couple percent. And now that in the future, they're not paying for those 4,000 employees to help with customer service, this is only going to get more attractive, while revenues could accelerate again in the next couple years. Altogether, with even the weak revenue growth we're seeing for Salesforce, they've increased profits around 30% in terms of earnings per share. And this story is only going to get better, in my opinion, moving into the future. If they can get revenue growth back up towards 12-15% growth, just that re-acceleration story makes the company more attractive. Not only that, we have around $50 billion that have been announced in terms of share buybacks, which will likely take a couple years to implement, but that's the equivalent of retiring around 20% of all shares. And now we're finally ready to look at the price chart of Salesforce and say whether I've bought shares in Salesforce or not. Now, the analyst expectations of Salesforce are kind of worthless because they include stock-based compensation. They give out shares to employees as a form of payment. That throws off all of the projections of P ratios and earnings per share. Just doing the basic math from their income statement, they are making around $2 in earnings per share per quarter right now, so around $8 per share this year all up. And looking forward, the earnings per share growth is somewhere around 30%. Taking into account that growth and the current stock price, we get a forward P ratio around 25. And again, that does not include stock-based compensation. And the forward earnings picture is looking like 25% growth per year. And that's for a company that is in online software and is a SaaS business or online recurring sales. That type of company usually has a very high valuation because they don't need to maintain physical hardware, depreciating assets, or actually that many employees. We could see a forward P ratio of Salesforce go back up to a 35 pretty easily. And that's why I've added Salesforce as a new company to my growth on sale model portfolio. And I think this company is attractive until it goes back to all-time highs. If you enjoyed today's video, I've got 2 more for you to watch here on the screen. I hope to see you guys there. Bye.